Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, October 27th, 2023. S&P 500 currently sitting at 4119. I'm David Zarling, and I've got with us the newest father of the team, Kevin Ferrari, while Ian is off for today. Kevin, welcome back.
Thank you. Yeah, it feels like it's been a while.
Yeah, a little bit. You always provide quality content for listeners, so it's always great to have you on here. And who knows, you might just have some wild new perspectives with a new family member in your house. Congratulations.
Yeah, thank you. Something different, that's for sure.
You getting sleep?
I'm pretty tired today. It was a long night.
Okay.
So,
do you guys do this in shifts, or how does this work?
yeah, we try to kind of flop back and forth.
Okay.
So I think I was up at, with them a little bit around 1, and then I just kind of got up for good a little bit before 4, I think.
I remember those days. Bless you. I do not envy other than the newborn baby part. Like, that part's awesome.
Yeah, and really pretty good sleeper for the most part. Occasionally he's got kind of a restless night thrown in there. So it's been pretty good.
Well, thanks for pushing through today, giving our listeners some great content. But I always like to ask, where would you like to start? Plenty to cover this week. We do have some new developments that we have been, whether you want to call it pounding the table or writing multiple market update letters for our clients, or even talking about on this podcast. We've broken some levels that are important to highlight. Yes?
Yeah, I kind of feel like Bill Murray in Groundhog Day because now granted, I don't necessarily get in on the podcast all that much, but I feel like, except for maybe the last time I filled in, the time before that, I think we were still talking about 4180, and here we are.
Yeah.
So I don't know if it's just me or how that works. It might just be bad luck.
You're basically waking up to the same alarm clock, same day, running into needle nose Ned and the 4180 level.
Yeah, there's just a small human now crying in the background. That's the only thing that's different.
Yeah, Colt's giving you guys the business.
Yeah.
You'll remember this time. And it's not just the S&P 500 that's broken 4180. And to be blunt, that's the level we've been talking about for quite a while and have written it down. We've provided it in Lunch and Learns. We've provided it on this podcast. We've broken that level. It's not exciting from a let's grow accounts standpoint. It just means it's more of a protective mode. And we're below a 200-day moving average. And if our listeners and clients remember, really we had a 3-step process that we had to adhere to back when we were still in a sideways trend or corrective mode in the S&P 500 is we had to A, get above a 200-day moving average, B, get above 4180, C, stay above those things. We did not do C. That's the problem, is we're below a 200-day moving average. We're below 4180. Paul Tudor Jones, one of the most respected asset managers in my lifetime, nothing good happens below a 200-day moving average.
No, definitely not.
And I don't know if you can think of anything that's even above a 200-day moving average. I can think of a couple sectors, but as far as a broad market index or even the Russell 1000 or the Russell 2000, that's just not what we're seeing.
No, and even if it is, I mean, it's not like it's giving you kind of a warm and fuzzy feeling where you necessarily want to participate in those, like putting new money to work in them, but pretty tough to find a good looking chart, at least in the short term out there.
In my head, I was thinking, energy, XLE is above a 200-day moving average as it sits currently. It is not. I was thinking of XLC, communication services, which has led us to the higher. It is above a 200-day moving average, but we got some information out of communication services, which is one of the leaders going into this. Would you say we got some information from that area this week as well?
Oh, yeah, I would say. Like if you're XLC, kind of below that, 63-ish area.
Mm-hmm.
And really there's kind of what should be kind of an area of support around 62, which is kind of where the 200 days heading. I mean, below there, that's looking a little dicey.
It's a little bit problematic. And a lot of this led by when you look at the makeup of that sector, when you look at XLC and you look at what's inside there, or you look at the sector, Google is the second largest holding in there at 22%. So the Meta, or Facebook, as some would know it, and Google are approximately 50% of that sector. Well, Google had earnings this week. And as our listeners are familiar and our clients are familiar, it's not the earnings that matter. It's the response to earnings that matter. And everybody anecdotally can say that that's factually true, right? They've been a part of where they're like, oh man, they just had a double beat. They beat earnings and then it sells off. Or they just had terrible earnings and the stock gets bought. We want to pay attention to those things. And Google had earnings this week. Meta had earnings this week, and they both got sold off. Now, whether that continues is to be determined. But the two largest components of the communication services, a leader, have now been sold. And so now it comes down to the Magnificent Seven. I hate to say it that way because it's so cliche when we talk about Apple and Google and NVIDIA, Amazon, Facebook. We just talked about Tesla. I don't know if I got all seven, but it's really these mega cap names that have been pulling this market higher. Now we're at a critical point.
Yeah, because really, how long have you been talking about kind of the differences and like equal weight and some of things like that?
Yeah, what are we seeing out of equal weight? Like it could be equal weight Russell 1000. It could be equal weight S&P 500. What are we seeing out of there?
Not pretty. I mean, really, it was the last like 3 months, I guess. Really kind of been pulling back. I mean, been below their 200-day. Like looking at RSP equal weight S&P 500, since basically this time last month.
Yeah, it is one of those scenarios where when you look at underneath the surface, and I'm going to ask you and our listeners to bear with me for a second because I'm going to try to communicate this as best I can. So we've talked about how, for example, it's been really narrow, a narrow market, meaning you have these really mega cap names that have been pulling the broad indices like an S&P 500, NASDAQ higher. Meanwhile, underneath the surface, to Kevin's point, you look at like an equal weight S&P 500, and yes, there are different S&P 500s. One of them is equally weighted. That is nearing its October 22 lows, so 0% return since October 22. You look at an equal weight Russell 1000, so think about an equal weight S&P 500, and then the next 500 in line, so your major leagues and minor leagues, if we could talk that way, now that we know our World Series contenders at this point. That is below important levels, and both of those below a 200-day moving average. It's also near its October 22 lows. So you have this bifurcated market where underneath the surface, there's a fair amount of pain. Tech had been holding things up. And when you think about seasonality, the weakness in this year from August, September, even part of October is normal. But you've also heard us talk about October being amplification month. And so we're right on that precipice, and I think we've described on here in the past, of a stretched rubber band. And there's really two outcomes for a stretched rubber band. It either snaps or it returns to its normal state. Its rest state is what I should say. This market, when you look at what's happening underneath the surface, these mega caps are either going to catch down, and that would be the rubber band snapping, right? You just have an acceleration to the downside, an amplification directionally to the downside, or this is the final flush in the final piece of October, which would be classic to see heading into November, December, January, February, March, and April, which are the best 6 months out of 12, that we see it rip higher from here. Time will tell. That's the hardest part is people want predictions, right? Kevin, you go to a doctor, you go somewhere, and it's nice to hear things are good. Things are going to be good. We don't have a prediction, but we can tell you that below important levels, such as 4180, it's a problem. And so, Kevin, I guess I want to ask you, thinking about both sides, like if we're to weigh the evidence that's out there in the court of technical analysis, in the court of supply and demand, you're never going to have the boxes checked one way or the other. But are there some things that stick out to you as far as like, this is a bit problematic for the market, or, hey, even though this is happening, this is holding up, and that might point to a certain direction? Any thoughts there?
Well, I mean, S&P below 4180. I mean, small caps talk about quite a bit below 165-ish, somewhere in there. I mean, that's kind of a big deal, especially if you look at, potentially how much lower that could go. I mean, that could be, another 10% down potentially from there until you get kind of some support.
It's a great point because if you think about it in terms of energy, and to paint this picture again, the Russell 2000 moved nowhere but in a massive range. And I can say that. I can say massive because it's the largest range in 50 years of plus or minus 20%. So a range of 20% that dates back to April of 2022. So you're talking about a over year-long sideways range. That's a lot of energy.
It's a lot of heartburn. You look at that, holy cow.
It is a lot of heartburn. That's multiple bear markets and bull markets in one, using a media definition, not our definition. And if that energy, so think about a small spring. So that would be a small range. And then think about a large spring and a large range. When you compress those, well, obviously the large spring, more mass, more compression, more energy stored up. You now sit here and go, that's a lot. If that was all distribution, if that's what this turns out to be. So that now we're in a scenario where either A, below this 165 level at Russell 2000 small caps, this is either about to accelerate because of the energy that was built, but we also have to be open to the flip side that this is some type of false breakdown being we move below 165, all the short sellers pile in, we move back above 165 and we're off to the races higher. But until we're back above 165, the thesis of an accelerated downside exists. Is that a fair
100%. And
summary?
And a lot of these charts are pretty well defined too. So I mean, it's not like these are necessarily really subjective levels. I mean, like 165 on IWM is about as clear as you can get.
Yeah, that's a good point to bring up. This isn't a subjective analysis. This is a fact. There's more supply than demand going back to October of 22 for small caps. There's more supply than demand going back to the first part of this year and last year for micro caps. We're now in a place where we really need to be paying attention to the Magnificent Seven, because those are the stocks that have performed the best since the beginning of January, since the beginning of this year. And here you have Apple, a general, below a 200-day moving average. Now it's a rising 200-day moving average. There's plenty of pieces here where you start to look at them and say, is Apple's price action a false breakout? And what I mean by that is Apple in June of this year had broken to new all-time highs. Let's call that the 180 level on AAPL, Apple. We've since broken back below that. Is that a false breakout? And I can use another sector as an example, is if we look at industrials, which is an economically sensitive sector, using XLI, it broke above the 107 level back in July and has since broken back below. That could be a false breakout. And all we've done has been sold since that point.
Yeah, and really today flirting with kind of that $96 level on XLI, which below there is not looking good.
It's not a great spot. And we actually see this across a wide variety of things. We're not just saying Apple and Microsoft. There's quite a few areas where we broke to brand new highs and then failed. The most recent example would be an area like insurance. When we look at something like IAK or KIE, these are ETFs that represent those areas. They broke out to brand new all-time highs in late October and they failed. And so there's lots of different spots where we're seeing, or you look at semiconductors. Semiconductors broke, super important sector or industry, broke to new highs in July and failed. So if that's going to be what we see across the board, are these failed breakouts, that is a potentially significant development heading into, especially the real clue will be, and our clients know this, our clients know that below 4180, below a 200-day moving average, we are now heading into protective mode. We are not a buy and hold shop. I call it buy and hope. We'll be moving to cash and cash equivalents for our clients. It's not a forward-looking statement. It's just our process. You don't know how we're executing that. So I can say that. When you look at this scenario, what it'll really be telling is November is supposed to be seasonally very strong. December seasonally very strong. If we don't get that, we have a scenario on our hands for 2024 that fits a panic cycle that runs about every 18 and a half years. I'm not bringing that up to scare anybody. I hope you're not scared right now, Kevin. I hope you're not scared. Or maybe you're dressing up as Ian for Halloween. I don't know.
Ooh, that's not a bad idea.
Yeah, I don't know if I'd pay money to see that. I would just enjoy it.
Mm-hmm.
But it's the weekend of Halloween. Kids get up, dressed up, do the trick-or-treat thing. Colt's not there yet, but you might wait. Actually, does he have a costume picked out? Or you guys?
Yeah.
Alicia's probably pretty good at that. She probably is like, let's do.
She already put him in a little bit of like a pumpkin costume and was doing some pictures one day. So that I don't know if that counts or not.
Mm-hmm. Absolutely, that counts. That's going in the baby book, man.
Oh man, yeah,
yeah. I think I remember our kids being little pumpkins or little candy corns, which is a very divisive candy corn. Some people love it.
Fights started over things like that.
Yeah, no, I've heard. It's kind of like the chili with noodles thing, or cooked tomatoes versus raw tomatoes. It's very divisive. So we try to avoid those subjects. But what would be very divisive for the market is if you have a weak November and December. So the possibility still exists that we have a strong November and December. It's just less likely below these important levels. And really, it is just numbers and math. If we're back above those levels, great. Like, that's fine. We can be back above them and be involved in this market, but below them, this is not the United States justice system, which is innocent until proven guilty. We're allowed to say this market is guilty until proven innocent. What else are we looking at, or are you looking at that has caught your attention, or maybe you just want to highlight for our listeners?
Well, this is, I guess, not necessarily that, but you're talking about the Magnificent Seven and then XLC. So I just happened to be peeking around in CoiFin, looking at like contribution data for 1 year. So Meta made up 78% of like the positive return witnessed by XLC over the past year, just Meta alone.
Wow.
And then Google was the next.
I was going to say,
basically made up the next portion of that, 20-some%. And then basically everything else kind of washed out. So pretty crazy to look at it that way.
Yeah. And it's definitely been a mega cap scenario across the board. It's not just communication services that's like that. You could say the same thing about tech. Like, you look at large cap tech versus small cap tech, that is two different stories going on. Like, and that goes back to the Magnificent Seven again. They're holding up those sectors. When you look at, and this is a sector that doesn't get a lot of play a lot of times, but it's the second largest sector in the S&P 500. That's healthcare. And when you look at healthcare underneath the hood, you do have your top components holding up: United Healthcare, your Eli Lilly's, your Johnson & Johnson's, your AbbVie's, with the caveat that just recently we're seeing Johnson & Johnson and AbbVie struggle. Like, these are some really large cap healthcare names. And then underneath the surface, whether you're looking at biotech stocks, or you're looking at pharmaceuticals, or you're looking at medical devices, there is a problem going on in healthcare. And I would say this week was also very definitive, a defining moment for healthcare as a whole. Using something like XLV, we've had this diamond consolidation going on in this sector. For those not familiar with that term, just think of the shape of a diamond, right? Don't overcomplicate it. I don't mean like a diamond that's on an engagement ring. I mean, like circle, square, rectangle, diamond. Think of it in geometry terms. A literal diamond. Price has moved that way, expanding, then contracting, and has broken to the downside in healthcare. There's a narrative that's about to be built, is my guess, coming out of healthcare that has not yet been defined. Everybody likes to talk about, again, I'm not saying these aren't things that we should talk about, but whether it's the Hamas, Israeli, Palestinian issue, it's crazy how quickly people forget, but there is an event in Ukraine as well, or whether it's talking about bond auctions. There's plenty of attention given to other areas, like even the Magnificent Seven, but I don't hear a lot of people talking about the pain that's in healthcare.
No, I think it was yesterday. Didn't you kind of make the connection to like the Boeing chart back in, what was that, like 2018, 19, leading into 20?
Yeah, Boeing at that time, what Kevin's talking about here is Boeing in 2018, 19, 2020 was also creating a diamond consolidation, and it broke to the downside. And Boeing at that time was one of the larger constituents of industrials. Like, when we think about the industrial sector, Boeing was a big part of that. And it broke down. And I'm not saying that this has to happen, but that kind of signaled that happened coincidentally with the COVID correction. But Boeing, once it broke down, dropped about 70%. Now, I would hate to see what the scenario is, why healthcare would be dropping to that degree. And that's not what I'm calling for. But what is noticeable is this is a almost 2-year consolidation move sideways in healthcare. And if we break down here, you would be, from a technician standpoint, targeting the depth of the range. So you'd be breaking down about 15% from here. So you'd be taking it down prior to the COVID crash. And that would be a little bit problematic as the second weighting of the S&P. That, like, it wouldn't help buoy the S&P 500, likely not moving back above 4180 if that's the case. I've talked too much, Kevin. So what are the things that you're looking at and noticing that we should be paying attention to?
Well, you kind of already brought up, like large cap tech. We're looking at NASDAQ, like Q's, kind of heading towards their 200-day. I think Q's breaking below their 200-day obviously isn't a good sign. They're really below this. It's kind of almost a retesting, kind of a breakdown below this 347 area there on Q's.
Mm-hmm.
So not too pretty looking there. Really the only area recently they really kind of had any play, I guess, was international, but now kind of some of the opportunities there have dried up as well.
What Kevin's not talking about is international broadly, although we could say international broadly to start the year definitely was a spot when we think about what happened from October of last year into January. International was a leader, but since then, on a relative basis, using something like VEU, the Vanguard All World Index, and it subtracts out U.S. stocks, and when we compare that to U.S. stocks, it's been in a downtrend all year long. With it, interestingly, since the end of October, starting to participate or outperform on a relative basis. But you're not talking about international overall. Are there specific areas within the international space that are noticeable?
The ones we talked about before, like Turkey, more recently, he's kind of been a player now. Japan's been a big one. And like Turkey now is just kind of holding above its 200-day. It's kind of interested to see where that goes from here. Japan, I know we usually reference the currency hedged version, so DXJ, which actually now, just looking at it now here, kind of breaking or threatening to break below 85. Kind of might be some warning signs there. Other than that, I know like Argentina was kind of a big one, which is pulled back below its 200-day now. So really kind of those, more targeted areas over kind of Q3 that, I had some chance to participate in, really pulled back, kind of like, more broad international areas.
Mm-hmm.
Vietnam, another one.
Yeah, Vietnam. India. I know India was a place, whether it was small cap India or growth India, that had held up well. But those are really targeted. I mean, we're talking Japan, Turkey, a little bit Argentina, India. We're not talking broad. And you brought up something in your opening comments there about the dollar. What are we seeing out of the dollar here?
Yeah, dollar kind of consolidating here above 105 using DXY. Just the run the dollar's been on since July is actually kind of crazy to look at. I mean, it's basically about as controlled as you can get a run up there for a while. But
and do you remember the narrative back in July of this year on the dollar?
Was that when they were talking about, what was it like, what they call those currencies?
Like reserve currencies?
Yeah, was that when like the oil trade?
Or like petrodollar and like the BRIC, like Brazil.
That's what I was thinking of. Yep, there you go.
Brazil, Russia, India, China.
Yeah, I can't remember if that was this summer or was that earlier.
No, it was. It was. It was the dollar's going to lose its reserve currency. The dollar's going to collapse.
Dollar's dead.
The dollar's dead. There were magazine covers. I even had really respected, and I know my family members listen to this, so whenever I say this stuff, please take it the best construction possible. But questioning like, oh man, is the dollar going to like collapse here? All we've done since then is move higher. And not coincidentally, right? That's been since mid-July. Equities have been correcting since the beginning of July. And this goes back to what you presented in July. And Dan reiterated in our October Lunch and Learn is just the correlation of the dollar versus equities. There's many times where there's a negative correlation. And it's really hard for equities to move higher with a rising dollar. It's just the dynamics of markets. It doesn't always have to be one-to-one, where we like to say that each chart should be taken on its own merit. At the same time, we need to be aware that the dollar performance is sensitive to equity performance, especially internationally, when we look internationally, but also domestically. And here we're sitting above a 105 level that you mentioned. It's going to be harder for stocks to move higher unless we're below that 105 level in this current environment. Is that a fair statement to say?
Yeah, and I think that's why it was even so interesting that some of those targeted areas internationally were doing so well just because of what the dollar is doing. But I know we've talked about that before too, like especially the commodities and the dollar kind of, you would expect that same, correlation historically, but really it's just not always the case. I mean, those relationships, correlations, can ebb and flow over time. And it's not really talked about that way, I guess, when you're, taught about markets, things like that. When you're going through school, they kind of more so treat them as, I guess, not necessarily concrete, but more concrete than we would think of them.
Right. They ebb and flow, correlations ebb and flow. And same with even licensing exams. which I'm a fan of. Like, there should be rules, there should be exams to test competency. Absolutely. But tool we can use, and the reason why we're technicians and appreciate it so much is when the dollar is rising, in general, if we have a general thesis that most stocks struggle in that environment, what do we want to pay attention to then? The things that are doing well.
Right.
And so you brought up commodities or those international areas that are doing well in a rising dollar environment. Well, man, how strong are they then?
Mm-hmm.
So they're actually running into a headwind, but they're running into a headwind and they're leading the pack. And you mentioned Japan and you mentioned Turkey. But what about the commodity space? I mean, I think there's some things there that are interesting considering a rising dollar environment.
Well, no, I think the most recent one we were talking about, at least kind of last time I was around, was oil, which kind of pulled back a little bit. Actually, kind of almost, I don't know if you'd necessarily call that like a false breakout. It kind of flirted with like 92, 93 a little bit. I guess it'd be probably more like a rejection there. But it's kind of pulled back since then. Other than that.
So what's the one commodity when you think of weak dollar that you're like, oh, that commodity must move higher?
Talking metals?
Yeah.
Gold?
Yeah. You look at precious metals and it's really noticeable that within the last few weeks, the move out of gold priced in dollars, that's a sit up, edge of your seat, take notice.
Especially today.
Yeah. The dollar has been strong since mid-July. It's not like gold has been. That's not what I'm saying. But most recently, you're seeing an environment of equity weakness and gold strength. That is a little bit of risk off type behavior.
Mm-hmm.
And it makes sense considering the current environment. And so we need to use this information. And gold is such an interesting one because when you look at it on an absolute basis, this range that we've been in since 2020, so a 3-year range, again, that's pent up energy. If that resolves to the upside using a bigger term time frame, I mean, that base that exists in that particular instrument using gold futures, that's pretty large. That's a move that you could see that would be upwards of 35% to the upside. I'm not calling for that. I'm not saying that that's what's happening.
Yeah, I'm writing that down. Actually, you called it today, 10:27.
You go ahead. I like that. That's good.
Well, you're talking risk off, right? What you would expect. What do you think about like utilities and staples then? Kind of what you're seeing there.
That's a great point. Utilities, if we think about the correction starting the end of July, beginning of August, utilities have actually accelerated to the downside in that environment. That tends to be a sector where you look at it as a risk off, a place where you can go for safety. What's interesting, though, is if we are in a new 40-year bull market for interest rates, so interest rates are going to move higher from here, utilities might lose their safe haven status, and you might actually see weakness out of there because they're carrying so much debt.
Yeah, that's a good point. Right, one of those long-term relationships now at a point of change, potentially.
Yep. Yeah. And then you look at staples, because I think you said staples, right?
Yep.
You look at staples using XLP, they've also sold off since mid-July, and really important level here horizontally at 65, 66 bucks. And not surprisingly, since mid-July, maybe I should say surprisingly, they actually moved downwards at a greater pace than S&P 500, with the exception of the last 2 weeks. And it's happening at a horizontal level versus XLP versus S&P happening at an important horizontal level that goes back to, guess what? The lows back in 2021. So it's going to be really interesting at this point, whether we see staples continue to outperform on a relative basis while declining on an absolute basis. And that is a corrective market. I'm going to say that again. If you have staples moving downwards, okay, so they're correcting, but on a relative basis versus the S&P, they're rising. All that means mathematically is that the S&P is moving faster to the downside. That is the, by very definition, risk-off behavior. So it's going to be interesting the days and weeks to come. Again, I think November and December are going to be so important from a 2024 perspective. You know, in Wisconsin, if you go outside in January and it's 90 degrees, we have a problem. Right? Either the sun is too close or someone has launched some type of weapon that has increased our temperature 4x our normal temperature in January. Same thing in November and December. We're supposed to be strong. Equities are supposed to be strong. If we don't get that in the coming weeks, That's going to give us a clue going into 2024. And you can have whatever narrative you want. Maybe we're talking about healthcare issues because we got healthcare breaking down. Maybe we're pricing in that there's more than 2 candidates for president. I don't pretend to know these things. Or we have some type of escalation of military events. I don't know. I don't like talking about fear-mongering things because we don't know these things until they're in place. But I think we do have to pay attention November, December as far as clues for what 2024 look like. And part of that requires patience, and people don't like patience. I don't know if you like patience. I don't know if Colt is patient.
Not so much.
So
he could flip the switch pretty quick.
Yeah. I mean, I think all humans can.
Mm-hmm.
And that's what we're dealing with now is you have an environment with investors where 2022, we corrected the first part of the year, then moved sideways the second part of the year. And so you really haven't had a market environment to grow assets or have those accounts move up in value. And that's a frustrating scenario for investors. And so this next sequence, this next 6 months, if you're a buy and hold investor, it could become very uncomfortable. And some of your decision making could be influenced by that. And as active managers, such as here, Client First, one of the reasons why we like to be able to use cash as a position is it allows us in environments where it appears that supply has more pace than demand to just pause the account, put it where it is right now. T-bills are, I know we talk about the 60-40 portfolio all the time, right? 60% stocks, 40% bonds. And there is some confusion from time to time on, because we haven't owned bonds for a long time. But when I say that, I don't mean T-bills. Those are technically bonds. They're really actually technically bills. That's why they're called treasury bills, T-bills. Own those? Absolutely, yes. But when we talk about bonds, Kevin, anything we're seeing in that space, is there any relief there? All we've seen is a correction in bonds. Any relief in the bond area?
Yeah, not so much. I mean, maybe looking like they want to consolidate here short term, but I mean, I guess you got to assume that they're going to continue lower, kind of in the direction of the primary trend now. TLT not looking that great. AGG not much better. Corporates, I mean, you name it, it's kind of rough.
A changing environment, and I do think it speaks volumes that if junk bonds versus your 7 to 10 year treasuries are going to decline at a lesser rate than treasuries, maybe it's giving us a clue at what investors think about the ability of the U.S. government to repay its debt. I have all the confidence in the U.S. citizen, everybody listening to this that, works for a living. One of the most productive civilizations on the planet. You guys pay your taxes. That's not what I'm questioning. I might be just questioning the financial decision-making of our government leaders to spend like they do, that our interest payments are what they are, that you could end up with a potential scenario where we view treasuries in a worse light than triple C junk bonds. So I digress in relation to that. Now that it pops into my mind, from when we look at like triple C credit spreads, anything to take note of there? The way I look at triple C credit spreads is just tightening or loosening of liquidity. It's the demand for money. You look at something like a high yield triple C credit spread, and believe it or not, since September, it's been moving higher. That means tightening. That means less credit available. Money costs more. I know before we started recording, you and I were looking at, I won't get into what ETF it was, but the corporate bonds that it's holding. And there's some really interesting and unique developments as far as the rates that are being paid on corporates. It's
a term too, I guess, at
right.
Those rates. It's pretty interesting.
Yeah, and I think that's a thesis worth, we can mention it here and discuss another time, but we know that Japan, that was one of the areas that you said has been a little bit more durable from an equity perspective to the upside than even the United States. One of the things that's unique about Japan is they do issue 50-year bonds for their government. The United States does not. And so they have the ability to push out their debt service in time, using time as their weapon to do that. The U.S., 30-year bonds. There was a president ago that was pushing for 100-year treasuries. Some people thought that crazy or irresponsible. I'm not sure. It depends on what you want your outcomes to be. But it is interesting to take note of that there's a discrepancy in duration of bonds, duration being a fancy word for how long it takes for the bond to mature. The United States, our longest duration treasury is 30 years. In Japan, as far as Kevin and I can tell, it appears to be 50 years. There's rumors that there's 100 years, but we couldn't actually definitively find that. There's an interesting dynamic between the countries that might have bond duration that's longer than the US 30 years. So I kind of took us off on a tangent there. I know that Dan is probably wondering when we're going to join our market call and manage risk, our regular day jobs. Anything else that you want to touch base on, Kevin, that we should be talking about?
When you're talking about rates, made me think, what are mortgage rates doing? You're closing in on 8%, which, hasn't been since probably like the late 90s, the last time you've seen maybe anything like that.
Yeah, I was going to say, when was
around the time I was born, probably somewhere in there.
Wow.
Mid to late 90s. It doesn't look like they're slowing down necessarily anytime soon. So it's kind of interesting to look at there. I think really the only thing other than that we kind of skipped over would be crypto.
Yeah. We haven't talked about that on this show for a long time. What are we seeing in crypto?
I can't even remember the last time. Well, really, do you think Bitcoin, it's like BTC, USD, has been moving sideways since summer of last year, and kind of finally breaking out above 31,785. Kind of what was that? Monday this week, I think, right?
Yep.
And kind of starting to move higher. So kind of quite the development there.
Yeah, it's a digital gold, right? Depending on how you look at it, and that's happening in a strong dollar environment. So here you have Bitcoin moving above that $31,000, $30,000 level, gold moving higher. Now, I get it. I know the narrative out there is, we've got some ETFs that are coming in line for Bitcoin. Whether that's it or not, I don't know. But Kevin's point is there's enough demand to outpace supply to get above an important level. That's been an area of polarity all the way back to July of 2021 in something like Bitcoin versus the dollar. If we can hold that, that's a positive development for Bitcoin. And frankly, we won't be opposed to own it for our clients if that's the case. How we express it is, I'll leave that for in-house, but it is notable, and I'm glad you brought it up. So we talked digital gold, regular gold, anything else in the commodity space. And I guess where I'm thinking about is just the difference between maybe agriculture companies. Are we seeing a difference there? You look at an ETF like MOO, MOO, one of the best tickers out there, actually. That's for agribusiness. And we continue to sell off, but yet we look at, DBA, an agriculture, that's tilted towards the futures of agriculture products, not the harvesting part. It's the actual products themselves, the pricing of them. And we're on the verge of breaking above the 22 highs and the highs that go back to 2016. That might be worth paying attention to, and that would be inflationary.
Looking this up because I was kind of curious. So what do you think the highest weighting is in DBA for product? Actually, try to guess the highest too.
I was going to say corn.
Mm-mm.
No. Okay. So agriculture is going to be your grains and your softs, right?
This made more sense when I looked at DBA because actually I wasn't expecting it to look this way.
Okay. I was going to say wheat as in my other choice.
Mm-mm. It's not in the grains, it's softs.
It's in the softs.
Mm-hmm.
So what would be the largest soft? Okay.
It's perfect with this time of the year.
I was going to say it has to be the American addiction of sugar.
Yep.
Or clothing like cotton.
Sugar's top, 18.3%. Then cocoa is second, and almost 16.
Do you know if that's a market weighted, like a cap weighted? Can you have a cap?
Yeah, I know what you're trying to say. That's a good question. How they determine that, I'm not sure.
Right. You said sugar is how much percent?
It was just a hair over 18, I think.
And cocoa?
Is almost 16%.
16%.
Next after that is cattle at about 13.5, which cattle is on a run.
Yeah, cattle. I was just going to say, cattle's been ripping higher since the COVID low.
And actually, if you look at that now, it's actually kind of an interesting spot. So, kind of breaking above, I don't know what you call it, like $1.80, and I don't remember what the contracts per pound.
And what are we talking about here?
Live cattle.
Live cattle?
Yep. It's like on TradingView, it's LE.
Okay.
Kind of the lead there.
And that's breaking above?
Yeah, it was up above $1.80, and then it's just kind of been consolidating, kind of threatened. It looked like it was actually going to break down below like $1.75 a pound, but it's actually held so far. So let's see here. It would make sense if you just look at the run that's been on, I would think, to consolidate for a while. It's been pretty normal and healthy. But man, that thing's been on a tear for a while.
That almost sounds like inflation. You're talking about one of the main ingredients in our food, whether you like it or not, sugar. you're looking at one of the main protein sources, live
Beef.
cattle. And then you look at a relationship like TIP, TIPS product versus IEF, a 7 to 10 year treasury. And that is reeking of inflation as well. And it appears that inflation may not be going away. And we have interest rates that are matching that, mirroring that, right? High inflation, high interest rates. The piece that's in there that I find fascinating is that's not an environment where you see a rising dollar. From a textbook standpoint, markets do what they're going to do. I really don't care. I've learned that a long time ago, that the textbooks are not right. They are a theory and they're not real world. But here you have a rising rate, rising inflationary, and really at the ground level, like fundamental level of food pricing, inflation going on in a rising dollar environment. It's just not what you normally see. All right. With that, I think we've exhausted it. You've got Colt dressing as a pumpkin, or he already did. I don't know what my kids are doing. I've got probably two. I don't know if my second youngest is going trick-or-treating, but I'm dressing as a Viking. I'm going to the Viking game versus the Packers at Lambeau this Sunday. And Vikings are notorious for actually scaring me. So we're going to see if that changes this year. Who knows?
I'll say if they're going to, this is probably the year.
Well, and I just think the Packers are a young team. Like, I don't know if Packer fans remember Aaron Rodgers' first year, but I believe, I could be wrong on this, I'm going off the top of my head, I don't believe they had a winning record. I believe they were sub 500, but it was obvious that Aaron Rodgers had some gifts. And I'm curious whether Packer fans, and I might be putting you on the spot because maybe you're disinterested and maybe not watching that much. If Kevin Love gives you the same, like, ooh, there might be some things here out of him for the future.
So I'm looking up. So is it right? 2005, I think, was his rookie year. You might have that wrong.
That's crazy. For Rodgers?
Oh, well, Favre was still there. So I'm trying to remember what year.
So I think he went 2 years under Favre.
More than that. Yeah.
All I know is the end of the Favre era was a contentious period, and that's when, many don't know this, but Ted Thompson shipped Brett Favre his locker down to the front door of his Mississippi home, and that was that.
Nice.
Favre was not happy, and I get it. I wouldn't have been happy either if I was Favre. So it's interesting about the NFL quarterback thing because it's my impression that guys that have a chance to sit and observe and learn do better than the guys that are thrown into the fire right away. Mm-hmm. And so are you saying Rodgers came in like his third year?
2008. Yep. And then they went 6-10.
So even after that, so 6-10, and that's McCarthy years, was head coach McCarthy.
Yeah.
And then, but after that, they were gangbusters, man. Like I believe they
didn't really look back.
They never closed below 500. I think they had winning.
I remember McCarthy's last year. Yeah, they were below 500. And then
that was his last
transition.
Year. Okay.
Yeah, with Fleur a little bit, but yeah, since then.
But I mean, all Packer fans is known is winning football, and I think that's great because a good Packers team. I have the same view about the Packers as I do about a Cleveland Browns team. Is that I think some of the best eras in NFL football are when teams like the Packers, the Browns, the Bills are good. So we'll see. We'll see what this Sunday brings. All I know is the trend is that the Vikings don't win Super Bowls. Maybe there's some type of washout on that someday before I die, but I'm not holding out hope. A trend is a trend.
Yeah, definitely wouldn't catch me putting money on it.
Nope, not going to do it. I will say, however, this is one thing I'll say, right, because I'm allowed to do this because a fan is called a fanatic, so you're allowed to be a little irrational. It's interesting to watch the growth of the Viking team over the last few weeks. They seem to be able to put a lot of yards up, and now the defense has figured out their blitzing scheme, and dude, they blitz like crazy. Watch it this weekend. They blitz so much. It's incredible. Anyway, we've digressed too much. We hope everybody out there has a wonderful Halloween weekend. It's also something called Reformation. It's when a guy like Martin Luther had the courage to post truths on a door. If you're familiar with that, great. If not, look it up. Otherwise, Kevin, I appreciate you filling in for Ian. It's always great to have you on here. You always have great insights. So thank you for doing that.
Yeah, you bet. No problem.
All right. Thanks, everybody. Take care.
Have a good weekend.